Level 1. I want to invest in the stock market. I should probably invest in mutual funds because I don't have the time to look at companies. Hey, these brands look good. Let me invest in these funds. Level 2. I want to invest in the stock market, but mutual funds are so expensive. Let me invest in index funds because they're cheap and they get you good returns. Level 3. Index funds are just not performing anymore. Therefore, let me invest in
Three, two, one.
Hey, how's it going? Welcome back to my channel. This is Pradeep and you're watching Vlog of Note. In this video, we're going to talk about why you as an investor should forget about mutual funds and index funds and instead consider this third type of investment vehicle. Let's get started. So first of all, usual disclaimer here, I'm not a SEBI registered investment advisor or a certified financial planner. If you want to make any investments, you should do your own market research. Now that we've got that out of the way, I've divided this video up into three parts for you. In the first part of this video, we're going to talk about mutual funds because there are still good ones out there. In the second part of this video, we're going to talk about index funds. And in the third part of this video, we're going to talk about funds that I will call FW funds for now. If you want to know what they are, you should stick around till the end of this video. Now let's jump in. Let's begin by talking about mutual funds. Mutual funds are a pool of assets from shareholders which invest in stocks, bonds, money market instruments, and other alternative assets. Important concepts that you should know about mutual funds include NAV or net asset value. That's the total value of the securities held by the fund divided by the total shares outstanding. A higher NAV does not indicate a more expensive fund. The second concept you should know is expense ratio. That's the percentage of your money that the mutual fund takes away, because they can. And the third is performance. Here's a hot tip. Take a look at the CAGR over the last 10 years and take a look at the return over the last 1 year. Now, the mutual fund industry actually began in 1924, over 100 years ago, with the Massachusetts Investors Trust, ticker symbol MITTX. The fund is still active today. Last 1 year, the fund has returned negative 15.02%. And before you get at me in the comment section down below, I will tell you that there is a point I'm trying to get at by looking at the 1 year return. I'll come to that in just a bit. Let's take a look at the disadvantages of mutual funds, shall we? First of all, mutual funds are expensive. There is something called the expense ratio, which is a percentage of your money that the mutual fund takes away every single year your assets are in the fund. Now, the expense of a mutual fund also includes a front load cost, which is the amount of money that the mutual fund takes away when you invest into the fund, a back load cost, the amount of money that the mutual fund takes away when you exit out of the fund or redeem your shares, and also a sales and marketing expense because the ads that promote mutual funds, they don't come cheap. Anyway, the mutual fund that I just spoke about, MITTX, that has an expense ratio of 0.7%. And I know what you're thinking, that doesn't seem like too much. Just consider this. If you had invested $1,000 30 years ago and it compounds at the rate of 11%, at the end of 30 years, your net worth would be $23,000. But if you have just a 1% expense ratio, guess what would be the reduction in your net worth? You're probably thinking, okay, 1% of 23,000 is $230, so I probably lost $230. The answer is $7,600. So that 1% is starting to look quite a bit expensive. Thankfully, we have index funds. In the second part of this video, let's talk about index funds. Index funds are portfolios of stocks or bonds that follow or mimic the composition and the performance of a popular index like the S&P 500. Index funds were started in 1976 by John C. Bogle or Jack Bogle or Saint Jack, the Bogle heads. The fund that was started then is still active today. It's called the Vanguard 500 Index, and over the last 1 year, it has returned negative 7%. Why do people invest in index funds? Well, they're cheap. The expense ratio is just 0.04%. Also, they have something called mean variance efficiency, which is just a fancy way of saying that for the amount of risk that they entail, they get the best returns. And people like Warren Buffett have generally said that you should invest in a low-cost index fund. He had that famous bet where he wagered that hedge fund managers would not be able to beat an index fund over the long term, and he won that bet. If index funds are so great, what are their disadvantages? Well, Dr. Dr. Michael Burry is one of their chief critics. He says that index funds will enjoy diminishing returns, and it's actually true. Over the last few years, index funds haven't performed all that well, and it's only getting worse. The thing is, once everyone starts indexing, it stops working. There is also another obvious flaw with index funds, and it's the fact that they are weighted based on market capitalization. If a firm is overvalued, it will cause the value of the index to go in the wrong direction, and people who will be indexing will be losing money. Take the example of Yahoo. It was announced on November 30th, 1999 that Yahoo would be included in the S&P 500 index, and in the next 5 trading sessions by December 7th, the value of Yahoo stock went up by 64%. People who were forced to buy it because they were tracking an index fund ended up buying an overvalued company. Today, Apple accounts for over 6% of the S&P 500, and if Apple stock were to fall, maybe you should touch your AirPods just for luck. If Apple stock were to fall, then the S&P 500 index would be severely impacted. That's why you have the third type of investment that you should consider. In the third part of this video, let's talk about the much hyped third type of investment vehicle that you should consider. It's called a fundamentally weighted index fund. It's similar to an index fund in that it tracks an index. However, the stocks in it are not weighted based on market capitalization. They're weighted on fundamental criteria like earnings, book value, cash flow, all that good stuff. In the 1980s, international investors had a problem. The stock market in Japan was severely overvalued. It was in a bubble, and their investments through an index were getting skewed in that direction. Therefore, Morgan Stanley invented an index which tracked based on GDP and not based on market value. In 2005, you had the rollout of the first major fundamentally weighted index fund. It's called the FTSE RAFI US 1000 index, and over the last 1 year, it has had a performance of only negative 1.8%, and it has an expense ratio of 0.39%. Why do we need fundamentally weighted index funds? It's because of something called the noisy market hypothesis. The noisy market hypothesis is the opposite of the efficient market hypothesis. It says that in today's trade, we have a lot of momentum traders. For example, you had that kid who made $110 million on the stock of Bed Bath & Beyond. Bed Bath & Beyond just this week went up by 92% on a single day without any change in the business fundamentals. You also have institutional plays like Bill Ackman and his Netflix debacle. He took a haircut of $430 million on the stock of Netflix last year, and he caused that stock to crash. And also you have lost tax harvesting. Basically, there is a lot of noise in the market, and an index based on market capitalization will not work, and that's why you have fundamentally weighted index funds. In 2005, there was a study by Robert Arnott, Jason Su, and Philip Moore which analyzed the performance of fundamentally weighted index funds. It was a simulation over the last 43 years, and it realized that these funds have actually outperformed the market by 1.97%. While you might think that that's pretty small, consider an investment of $1,000 over 35 years. Want to take a wild guess as to how much you would have accumulated had you invested in a fundamentally weighted index fund? The answer is $50,000, twice as much. So there you have it. Mutual funds, index funds, and fundamentally weighted index funds, an investment vehicle that you should definitely consider as a level 3 investor. If you have any questions, please do drop them in the comment section down below. As always, please go over to YouTube, subscribe to the Blog of Note channel, ring that notification bell so that you never miss a video, and I will see you guys in the next episode.